when you take a look at what BI did, is it trying to prop up growth now that the rupiah is kind of stable?
So I think the decision yesterday from BI is actually a very clear shift in its monetary policy stance from one focused on growth risk actually to focusing a bit more on financial stability, external stability, and most importantly, the currency stability. Now, I think it actually goes a step further than that. What we saw yesterday is actually an unprecedented move in terms of coordination between fiscal and monetary policy, because that same reduction in the RRR that you just mentioned, it's actually expected to go directly into the government bond market to help the government finance its deficit, which is needed to fund the stimulus for COVID-19.
Is it enough, though? Because we know that 4 million Indonesians sought jobless funds within just 3 days, and unemployment is expected to rise, given that pretty much 60% or more of Indonesian workers are informal workers, informally employed. I mean, are all the measures so far enough to provide that buffer?
So I think we have to look at this in context. Going into the crisis, Indonesia is one of the countries with the least fiscal space, actually. It had a deficit rule limiting the deficit to 3%. Now, the government did take relatively decisive measures. It removed the 3% cap to provide some flexibility, and it basically is targeting a deficit of 5.1%. So this really is unprecedented for Indonesia, given that this fiscal law has really anchored the country's macroeconomic stability since the Asian financial crisis. So, you know what? I think they are doing quite a lot, and it is commendable. But at the end of the day, it is still quite difficult for them to finance this deficit. At the end of the day, Indonesia runs a current account deficit. It's reliant on external financing. So it is a challenge for the government to fund it. And that's why we do see the central bank moving in quite decisively to both free up domestic liquidity, but also to keep the policy rate on hold to attract foreign capital. Because at the end of the day, EM flows to emerging markets are basically seeing a sudden stop in the last few weeks.
Well, in terms of Indonesia, it seems there's been capital flight. Just look at the state of the bond market, Joseph. So by staying pat, do they engender some confidence?
That's precisely the idea. I mean, they're hoping to really maintain a high real yield to attract foreign investment, to basically show that they will maintain external stability. Now, we don't really think this means they don't do further rate cuts. At the end of the day, growth is slowing quite sharply. But it's a question of balancing the growth and the stability risks. They can't just be cutting like other central banks in the region, which perhaps run current account surpluses. They don't have this same external constraint. So they're really in a very different ballpark compared to the rest of the region. And we think that given the circumstances, they are doing the best they can.
Who in this part of the world, then, or in Asean, is doing the best, in your view, with regards to fiscal stimuli?
So I think, undoubtedly we have to look at countries like Singapore. And at the end of the day, Singapore really is in a very different category, given that the country has massive fiscal reserves that it's able to tap in a time of crisis. So, we're seeing the government paying wage subsidies up to 75% of wages in some sectors. And they're basically targeting even more fiscal stimulus in the months ahead. So we might see something as much as 15% of GDP of a fiscal package. But I think, outside of ASEAN, we also have to look positively at Korea, where the government has been running, a structural shift, let's say, towards higher fiscal deficits, mostly in social spending. So that's also provided a lot of support for that economy. So there are a few bright spots in the region when it comes to fiscal policy.
And Joseph, is China providing some kind of support, some kind of stability for Southeast Asian economies? I mean, today we saw the PBOC adding liquidity. We've seen pretty much some kind of resilience in the economy. Trade, for example, came in contraction, but better than expected. We had PMI coming in better than expected as well.
Yeah, that's a very good question, and it kind of encapsulates how this whole debate has shifted. At the very beginning, we were looking at, the sensitivity to the mainland economy. Essentially, the economies with the strongest growth linkages were really the ones that were going to be impacted the hardest in this crisis. But basically, as this has shifted from a China issue to more of a global issue, in a sense, we are seeing maybe some stability come from China. Chinese imports have been relatively resilient, we would say, in the last few months, and as a result, that is providing some respite for the region. Now, at the end of the day, I think the degree of policy support in China, while it's moving in the right direction, is a bit less than many of us were expecting at the beginning of this crisis. So, the total fiscal policy stimulus is definitely much more restrained compared to, of course, the global financial crisis. So, we do have to be realistic about the amount of support that can come from the mainland economy. But generally speaking, we are seeing some bright spots, let's say, in the external sector. So one area, and not just related to the mainland, but more broadly speaking, is in electronics, where we are seeing the activity hold up a little bit better than we originally expected.
Consequently, Joseph, can Southeast Asian currencies be well supported because the yuan itself has been stable?
Exactly. We've seen in recent years that the renminbi and its stability has been very important for actually broader external stability in Asia, given that China is the biggest trading partner. So particularly economies like Vietnam have a very high sensitivity with its currency within China, but also countries like in Indonesia, where the rupiah really is the focus right now. So China is one factor. Of course, the bigger factor is the Fed, and the Fed really has been doing quite a bit to ease some of the dollar liquidity constraints. Most notably for Southeast Asia, the Indonesian central bank confirmed that it does have access to this latest Fed repo line, which again, when it was announced at least, really helped to ease some of the pressure that the currency was seeing.
Joseph, out of the countries you cover in ASEAN, which economy is the most worrying, or the one which is most imperiled in your view?
Well, the way I'd frame this answer is really in terms of understanding how bad the outbreak is in the region. So remember, this started in China and North Asia, spread to Europe and the U.S., and largely speaking, in most of these regions, we've passed the worst, it seems. We're on starting to see some signs of improvement. But for most countries in Southeast Asia, we really don't know how bad it is because testing has been incredibly insufficient. So, for example, in terms of tests per 1,000 people, in Indonesia, we're at 0.1. And even in the United States, which has been slow in ramping up testing, that number is 8.5. So we really don't know how bad it is. And I guess from a COVID-19 perspective, Indonesia is perhaps one of the countries where we're continuing to see relatively strong increase in the number of cases. And as they ramp up testing in the weeks and months ahead, we expect that number to get a bit worse, actually. So perhaps, Indonesia is one area where we are monitoring, and even the government has been quite straightforward in expecting the case numbers to get worse. So really, where we go from here really depends on government actions. This is one of the countries that hasn't yet kind of pursued a national lockdown. We had social distancing restrictions start in Jakarta yesterday. So we're really observing how the restrictions go forward and how that contains the virus from here.